Hello and welcome to Simplicity in Stocks. In these videos, we will dive into the important foundations of investing. Today's topic is growth investing or value investing, which is the better stock market investing strategy for you. First, what is value investing? Value investing is a method of finding out a company's true or intrinsic value. Value investors buy a stock when it's trading below its intrinsic value and sell it when it trades above that value. Now let's examine value investing's cousin, growth investing. First, you should know what growth investing is not. Growth investing is not about any of the following. It's not about preserving your capital. It's not about keeping your money somewhere safe. It's not about keeping up with inflation. It's not about earning a regular income from investing. Growth investing is about one thing only. That is, increasing the value of your investment portfolio, preferably at a fast rate. That's it. It's the only thing all growth investors want. As long as their investments are gaining in value, growth investors are happy. If their investments fall in value, most growth investors, with some exceptions, will consider selling. They may even use stop losses to ensure they don't suffer a big loss. To a growth investor, if a stock isn't going up, then it's not worth investing in. It's as simple as that. This is contrary to the thinking of value investors who want stocks to fall so that they can buy them cheap. So what explains this difference? Difference between growth and value investing. The fundamental difference between growth investing and value investing is in the decision to buy and sell a stock. Value investors buy low and sell high. Growth investors buy high and sell higher. Value investors desire a margin of safety in all their investments. They want to buy stocks at a discount to its intrinsic value. This is the central concept of value investing. The need for a margin of safety is why value investors wait for stocks to fall before buying. When a market correction brings stock prices down to low valuations, they buy. Then they wait for the market to take the stock back up to a fair valuation. Then they sell. This is how value investors buy low and sell high. It's a proven, time-tested, market-beating investment strategy. It's used all over the world by many successful investors. But value investing has its drawbacks. One, it demands emotional stability from investors during volatile market conditions. Two, it insists on a margin of safety before investing. In its absence, value investors don't buy stocks. Three, it requires investors to buy stocks only at cheap valuations, often at low price to earnings PE ratios or low price to book PB ratios. If these conditions are absent, especially during a bull market, then value investors will not find many stocks to buy. They may have to sit on cash. That's the very nature of value investing. On the other hand, growth investors care only about growth. They are always on the lookout for stocks with significant upside potential. Concepts like margin of safety are not very important to them. They are mostly interested in knowing the reasons why a stock will go up. The most important reason being the growth in the company's earnings. In growth investing, the buy and sell decision usually comes down to earnings growth. Growth investors believe that if a company can grow its earnings, that is the net profit and the earnings per share (EPS), at a high rate, then it merits investment. So what do growth investors consider before buying a stock? Growth investors usually consider the following points about a company before investing. Rate of EPS growth, both quarterly and annually. Rate of sales growth. Growth relative to the industry and the rest of the market. Historical growth and the future growth outlook. Size of the company. Smaller companies tend to grow faster than larger ones. Likelihood of an increase in the profit margin. That is, can profits grow faster than sales? Clearly, the two investing strategies are like night and day. This is why most investors tend to prefer one over the other. They find it difficult to do both at the same time. So which strategy is better? Before we come to that, just a reminder that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now, coming back to growth versus value, the answer comes down to personal preference. Investors tend to prefer one over the other based on their own investing temperament. Instead of asking which is the better investing strategy, growth or value, ask which is the better investing strategy for me. For example, do you like the idea of making a quick profit when you buy stocks after a correction and then sell them after they bounce back? If so, then you may be inclined towards value investing. Or do you like to study companies to find out how much they can grow? If so, then you may like the idea of growth investing. Before taking the plunge, think carefully about this decision. Ask yourself why you want to be a growth investor. Are the profits that you are making from the stock market too low? Also, what are the returns that you have made from value investing? You might discover that your returns are good enough and you may not need to take on additional risk to buy growth stocks. And that's fine. Growth stocks have a lot of investor expectations driving them higher. This is why they trade at high PE ratios. In fact, they are the most expensive stocks in the market. If the expectations of investors are dashed due to poor quarterly results or some unexpected event, then growth stocks will crash. There is also the industry aspect to consider. Value investing doesn't always demand good industry knowledge, but growth investing does. Are you willing to put in the extra time and effort to understand how the industry works? If not, then growth investing is not for you. To be clear, this is not an attempt to discourage you. If you think you have the temperament to be a growth investor, then go ahead. Just keep all the risks in mind. To make your journey smoother, here are a few points to keep in mind. 1. Start with high quality stocks. Read annual reports, look for fundamentally strong stocks, no matter how fast or slow their growth rates are. 2. Look for growth over the long term. Check the last 7 to 10 years financials. This will weed out any companies with short-term growth spurts. 3. Avoid companies that fund their growth with a lot of debt. Insist on a debt-to-equity ratio below 1. The lower the better. 4. Don't invest in any loss-making company or turnaround companies. 5. Try to understand the industry dynamics. If the industry is too complex for you, then don't invest in those stocks. 6. Don't overpay for growth. Don't buy stocks at 60 or 80 PE. Put an upper limit for the PE ratio with which you are comfortable. Ideally, a PE not more than 30 or 40. We hope this video has opened your mind to the idea of growth investing, its pros and cons. You are now in a good position to decide if you want to be a growth investor or make the jump from value investing. Happy investing!